you can see that based on the data, it's predicting around a -6% annual return on the S&P each year over the next 12 years. We don't know if that's going to happen all at once. We don't know if it's going to happen in a slow period of time. We don't know if it's going to happen at all. But the model says in the past it has, and the model is highly correlated to real results. Hello, it's Mike Preston at New Harbor Financial Group. It's July 25th, Thursday, 2024. Here with New Harbor's weekly update and some insights into the market. We hope to bring you some data and some insight and some purpose into your investing activities, and hopefully just give you some ideas and or give you some education. That's what we're here to do, and to give you some updates on what we're doing and what we see. Make sure to watch it through the end so we can share some of the market moves that we've made, what we think we're seeing. There's a lot of people that are nervous right now here as we sit on July 25th, 2024. The S&P is down about 5%, not quite. The Nasdaq is down roughly 10%. These are approximate numbers, and folks I'm seeing many folks online and on Twitter are really nervous, and they've got right to be nervous because the elephant in the room is the valuations of this market are not sustainable. And so we think we know how this ends, and it doesn't end well, and yet psychologically people feel like they want to be in it. And we as money managers, we obviously want to make some return for our clients when we can. So we have to go on data and experience and make some decisions based on that, and with some hedges in place. All right, so here's a daily chart of the S&P 500. We are down about 5% or so. We have bounced solidly off the 50-day moving average. This is key. Let me back up and just show you how extreme this market has been over the longer term. Here's the weekly chart. Basically over 3.5 years, you can see the market's been straight up most of the time since April. There's only 2 down weeks here. And if we go to the monthly chart, you'll see that this is just a blip. So the big question everyone wants to know, is this the top? Is this the top? Well, we don't know for sure, but if I had to guess, I'd say it's not the top. Now, why do I say that? And again, with full disclosure here, I don't know the future any more than any one of you do, but I've got 25 years of experience. We've got a lot of experience here at New Harbor. We've been through all the bubbles. I've seen all the bubbles, the tech bubble, the housing bubble, and this bubble, the everything bubble. My opinion is this: the market likely hasn't put in a top yet, simply because I haven't seen enough fear of missing out. I'm seeing a lot of nervousness very quickly here, and there hasn't really been any FOMO here. Now, that's not to say I'd bet on this, because that is not a quantifiable thing, that I haven't seen FOMO. But I'm telling you, I've been around a long time, and I saw a lot more fear of missing out a year or two ago than I do now. During this time, there was more FOMO. And certainly if you go back even further, post-COVID, there was a lot more FOMO here. Strangely, there wasn't a lot here. I know that there's probably some charts out there where you can show bullishness and put-call ratio and things like that. I'm only telling you a boots on the ground type situation, and do not take this advice as investment advice. This is only me reporting I see and what we have seen here over the last bunch of months. Haven't seen a lot of FOMO, fear of missing out. So this so far is a pretty normal pullback of about 5%. The Nasdaq, it's a little bit more. It is through the 50-day moving average, and it's approaching 10%. It's bouncing today. We'll see how we close. So, what would I do? What would I do now? Well, first of all, if you've got too much stocks, I would reduce quickly, frankly, and you frankly shouldn't have had too many stocks along the way. We've been at around 40-ish% stock exposure, and I think that's a pretty good place for most people to be, maybe a little bit lower. We have hedges in place that help us feel a little bit more confident being with that exposure. We're able to buy strong sectors. We did, by the way, just add Telecom in the last week. Telecom is a sector. I'll just use this symbol as a proxy for the telecom sector. We had a nice base formation, inverse head and shoulders. This would be a head, and this is might be stretching it a little bit, but this would be a left shoulder. There's a right shoulder, and then a breakout of that base. Looking at a longer term chart, a weekly, we've had a nice inverse kind of head and shoulders formation, even on the weekly, and a breakout. All of our indicators short term were relatively bullish. A week or so ago, we added this position. It's a small position, just a few percent, and we still remain in the low 40s percentage-wise. And we have hedges below. So if we fall, for instance, through 5,200 on the S&P, we have hedges that kick in, and that will drop us down to the 25% or so invested level. So what should you do with this early kind of warning sign? If you have too many stocks, you need to reduce, because I don't know if I'm wrong here about a bounce and or a further melt up. If I had to guess, I think we get a further melt up for a few months and then a rollover and then a big drop. Ultimately, a very large drop. I predict more than a 50% drop over the next year or two, based on where we are in the cycle. So if you have too many stocks, reduce. Cash is a great alternative here at 5%. Buy some treasury bills, all under 1 year, basically above 5%, and or use options to hedge. If you know how to use options, you can buy protective puts, you can sell calls to bring cash in to pay for those puts. All of those strategies have trade-offs. If you sell calls, you're going to give away upside above a certain strike price. If you buy puts, you're going to pay for the insurance, and there's a cost to that. So all that is to say, what do we think the market's going to do? Well, so far, I see a lot of nervousness very quickly. I didn't see a lot of fear of missing out on the way up. It was a narrow market. It was all Nasdaq, and it started to broaden out. For instance, we saw the Russell 2000 have one of the biggest moves in a short period of time ever. The Russell 2000 here has been in consolidation for a long time, really going nowhere. Then all of a sudden, 2 weeks ago, it broke out from the 200 level on IWM and boom, went right up to 220. And since then, it's been consolidating in this area, consolidating here. My guess is that probably breaks higher. So we've started to break out and widen out. So it was all Nasdaq. Now the Russell 2000 starting to participate. The Dow started to participate with a pretty big move, and it's also had a pretty big pullback. But bear in mind, we're not even back to the 50-day moving average yet. How to prepare for what is likely going to be a crash at some point, albeit not now. The way we're managing money is basically the advice that I'd give to people out there. Reduce stocks. I know I said it earlier, I'll say it again. Get yourself down, for the most part, to a lower stock level. I think that's good advice. Everyone's situation is different, and we're happy to have individual conversations if you'd like, but the market is hyper overvalued. I'd like to just share with you what I think is the elephant in the room: hyper overvaluation. Our good friend and colleague John Haussman put out another piece just a couple days ago. He's been consistently warning about valuations, and I know it's been a long time that we've been warning about valuations too. Here is John Haussman's favorite valuation metric: non-financial market cap divided by non-financial corporate gross value added. Essentially, it's a twist very similar to market capitalization divided by GDP. This data goes all the way back to 1928. So basically 100 years. You can see that where we are on July 17th of 24 is right at the tippy top of valuations, basically as high or higher than it was in 1929, and certainly the highest level, really in the last 100 years. Now, does it matter? That's the real question, because it's been that way for 10 plus years. The markets have been hyper overvalued. What I like about John Haussman is to take this data and then plot it against not expected, but actual returns in the S&P 500 in the last 12 years. And so when he plots out that data, essentially what it's trying to do is predict what the S&P 500 is likely to produce over the next 12 years. And that's the next chart, which I'll share now. Now, here is all of that data plotted this way. Essentially, you can see that the correlation fit line here is pretty good representation of the data. Non-financial market cap divided by corporate gross value added. And then this vertical chart here is actual subsequent 12-year nominal annual total returns. You can see that based on the data, it's predicting around a -6% annual return on the S&P each year over the next 12 years. We don't know if that's going to happen all at once. We don't know if it's going to happen in a slow period of time. We don't know if it's going to happen at all. But the model says in the past it has, and the model is highly correlated to real results. So for that reason, we give it respect. The elephant in the room is valuations, and yet it's been that way for 15 years. So does it really matter? Is the end here? I don't know. If I had to guess, I'd say no. I don't think the end is quite here. The market probably pops higher for a few months and then rolls over before the election, maybe October. It's just a guess, though. I wouldn't be playing around with these valuations if you're doing this on your own. Get yourself down to a lower level of equities, get into some treasury bills or some cash equivalents that pays you a reasonable return. You can get around 5% right now. Lastly, reach out to us. If you want to have a filter for your emotions, if you're not sure what to do, talk to us. Look in the link down below. Subscribe to the channel. Share your comments with us. We really appreciate them, and we really appreciate you watching. We look forward to sharing every week with you our thoughts and what we're doing. Until next time, this is Mike Preston, New Harbor Financial. Thanks.